Oh, that's real good.
Hello everyone, and welcome to our channel Penny Lesson. We talk about everything finance, from tips on making money and proper investing to news about the different economies and situations affecting the global markets. The goal of this channel is not only to teach you how to be more financially responsible but also to teach you how to be more aware of global events. So why not just sit back and relax while we tell you what's happening in the finance sphere? Be sure to subscribe to my channel and hit the notification bell to be constantly updated on my latest videos. Remember, one penny lesson a day keeps being penny less away. With the type of news circulating around global television lately, it's best to be prepared for the different types of scenarios that might play out. Why not sit back and listen to experts' opinions about the matter? Maybe you can pick up a thing or two that you can use to help you invest better. Resulting of the sell-off on Monday, the tech sector of the S&P 500 has now seen a monthly loss. Dan Ives and Charlie will be joining us for a bull bear discussion. Let's hear what Dan has to say about the sector to start. He has recently expressed optimism for the tech sector, but his main argument is that the Q2 figures seem to support this. Dan mentioned that the fundamentals hold up a lot more than fear, especially with all of the bearishness we're seeing, as evidenced by earnings season from Microsoft, the cloud, cybersecurity, and industry heavyweights like Apple. That is really his thesis, which is that as this plays out, tech stocks will ultimately be in the black. In general, Charlie disagrees with the claim that the market grew too enthusiastic about technology because the rate cycle was slowing. When asked about this, he mentioned that during the past 2 years, tech stocks had significantly benefited from several tailwinds. As a whole, tech stocks performed admirably with COVID, the Pelotons and Zooms of the world, and have greatly benefited from historically low interest rates. Low interest rates help tech and help growth much more than value stocks, so when the tide goes out, we see who's been swimming naked, and many tech stocks look unsuitable here. So they have experienced several tailwinds. He then mentions how we can now begin to predict how they will perform in a typical setting, in terms of his thoughts about the notion that we are in a structural innovation cycle where macrocyclicality will really be unimportant given what technology offers to our lives and incomes. Charles notes that the mainframe computer and improvements to transportation are what everyone constantly claims would alter technology in the 1970s and 1980s. Which is why tech companies usually trade for enormous multiples. But over the past 100 years, value stocks have outperformed growth by around 3% on average. Why? Because everyone always wants to own the glitzy, expanding firm and never wants to own the one with a consistent, reliable cash flow. Everyone aspires to become the following Facebook or Apple. Value has far surpassed growth, which is why it frequently doesn't come true. People talk about the Fed, but 8.5 CPI is a long way from 2, so there is a chance that technology may make mistakes along the road. Sharing his thoughts about this matter, Dan believes several brands falter, like Zoom, DocuSign, and others. He sees that we are still only 40% through the cloud. Cybersecurity and the cloud are both experiencing the fourth industrial revolution. You gaze upon the Gibraltar's cliffs as you would an apple. So, in the end, Dan believes it foreshadows how technology will split. You must possess the appropriate names. But despite some of the rallies we've witnessed over the past month, he feels that right now is still as gloomy as 2009 and 2010. There aren't many company names on Charlie's list, including Peloton, Amazon, Netflix, and Zoom. Charlie was asked whether the argument holds true in the event that business investment declines, in which case the business sector will be the main source of any difficulties. Charlie responds that it's possible that he could use caution and say that there are some tech names that he believes will succeed, such as Oracle, which is reasonably priced at 14 times earnings and has a sizable enterprise and hosting business. However, many of these names aren't fundamentally sound, so you must return to valuation. We have many technological names with values that are disconnected from the fundamentals, and the fact that we have zero real interest rates has allowed them to exist in this environment, despite the fact that I know it's dull and that many investors detest discussing valuation. Moving on from that discussion between Charles and Dan about the future of technology through fundamental analysis, we now have Rich Ross to share his thoughts on software through technical analysis. Some people say we've hit rock bottom, but Rich Ross of Evercore disagrees. How come? Let's start with software. What is the IGV telling him right now? It's telling him what a lot of tech and markets are telling us, that after a very encouraging rally in lows, we have fallen back into that pattern. The Jackson Hole comments have undoubtedly made this situation worse. Still, we are seeing an ETF or sector ETF struggling to hold on to support here, around that 50-day moving average. However, he doesn't believe that the recent weakness following the Jackson Hole leading up to the event is a precursor to a larger retest of the lows. Instead, the software will find its footing, and the breakout we saw in July, that surge, was really more of a preview into the future of what we will expect this fall. In light of recent events, does he still believe that point of view is being accepted? Well, unfortunately for the bulls, there is a lot of technical symmetry in the market right now. This is the typical setup that indicates a bear market collapse of somewhere between 30% and 70%. Our opinion is that this is a retest of that surge and that we have made the turn. The bottoms are in, but as always, the bottom is a function of time, price, and in this case, volatility. However, in June-July, you get that big surge, that textbook reversal off of long-term support from deeply oversold conditions. In this case, volatility. The holiday season doesn't begin on Black Friday anymore. It starts sometime in October, and there are a lot of questions about inventory and consumer demand, and how much of this will come from e-commerce and data from sources like Adobe and others about what they anticipate for this season. Will that have a significant effect on how the software performs? Charts are starting to show us that pricing has a tendency to undervalue future fundamentals. Not necessarily with every stock, but frequently with the important stocks. You are beginning to see the positive technical indicators that would imply that the fundamentals down the road would curve in the correct direction. Breaks in clearly defined downward trends and extremely strong bases in equities like Intuit show this. Massive consumer stock, Amazon, the largest consumer stock in Amazon, had done something it had only done once before, in the midst of the financial crisis, but it is not the reason you should purchase Amazon. Well, there we go. That's quite the discussion, really. Here we just heard three people's opinions about the tech industry. Given both their technical and fundamental analyses, what do you think? Personally, I think it's best to be optimistic about the tech's performance in the latter half of the year due to global events. Well, will tech stocks really boom in the coming quarters? Let me know in the comments below. Wow, was that news? Why not ponder it? Want to know the latest? Comment if you want more articles like this. This video is just one of many videos on my channel that brings you the latest news about the world of global finance and economics. So go hit that subscribe button if you don't miss out on content like these. If you enjoyed this video, please hit the like button. Thank you for all your support, and I'll see you again next time. Remember, 1 penny lesson a day keeps being penny less away. Cheers.